Hello, welcome everyone. My name is Charles Williams. I am the managing member for Pioneer Realty Capital, and today we're absolutely pleased to present one of our capital partners we've worked with over the years, Trevion Capital. Today we're going to talk about bridge loans and talk specifically about their program. But before we get into our podcast show today, there are a couple of things, housekeeping things I want to be sure and mention. If you're watching this show on YouTube, be sure and subscribe to our channel and hit the like button. This is our indication that the information we're bringing you is valuable. The content is something that you appreciate, and that allows us to continue to drive more capital partners to our program where they can talk about their various products. And then the second thing I wanted to mention, I guess there are two other things I wanted to mention. One, take a look at our CREmembers.com social media platform. It's the LinkedIn for commercial real estate. So this gives you an opportunity to really connect in the commercial real estate industry. If you're a capital partner, it allows you to promote your product, your capital programs. If you're someone who's transitioning into commercial real estate, there's training there for our pro members, and there's a database of lenders and just all kinds of information available to you if you're active in the commercial real estate industry. Now, with that housekeeping out of the way, with those things being said, let me introduce a dear friend of mine, Mr. Charlie Zabriskie with Trevion Capital. How are you doing, Charlie?
Good, Charles. Thank you. Appreciate you having me. Good to see you.
Yes, nice seeing you. As
Virtually,
we
at least.
mentioned before we started the show, it's been a couple of years pre-COVID that we actually had a chance to see each other down in San Diego.
That's right. Yeah.
Yeah. So COVID has changed a lot of things in the commercial real estate space, and I'm sure we'll get into that. But for the benefit of our audience, tell us a little bit about you, your background, your bio, and then tell us a little bit about Trevion.
Sure. Yeah. Thank you. So Charlie Zabriskie, I'm a principal at Trevian Capital. I've been here since shortly after inception. The company's been around for coming up on 9 years now. And we are commercial real estate bridge lenders, and I'll obviously spend a bunch of time talking with you about what we're doing, how we look at the world, how we operate. My background, or for starters, I oversee originations here at Trevian, nationwide bridge loan originations throughout the U.S. Prior to Trevian, I was with CMBS and commercial real estate debt transaction support shop, heavy loan underwriting and diligence. And before that, I was with a real estate family office here in New York with assets both locally in New York City as well as in the Southeast, in an acquisitions and underwriting analysis role, dating way back to 2005 when I came out of school. Went to NYU for a master's in real estate finance, where I met Michael Hoffenberg, who founded Trevian, and came to join him shortly thereafter. And another former colleague of Michael's, Andy Smeltz, is our head of operations, and three of us have now been working together for about 7 years. So that's sort of quick and dirty on me. Yeah, I think more interestingly is Trevian and what Trevian's up to these days, which I'm
Okay,
happy
yeah.
to jump into, or I'll take your lead.
Well, yeah, and I appreciate that. So as I mentioned earlier, we're going to talk about bridge lending, and of course, that's if I'm correct, that's the primary space that you play in.
That's right.
Or have things changed? Or you still focus just on bridge lending?
That's right. Yeah, we are bridge lenders.
Okay. Well, tell us about your product, your brand, how you fit, in the commercial real estate finance. What part of that life cycle you're financing. But just give us some information about Trevion, its background, and then we'll dig a little deeper.
Sure. So I'll turn back the clock briefly. When we started early 2013. The real estate bridge lending space was very regional and fragmented. So you had a lot of folks in New York lending in New York. You had a lot of folks in California lending in California, some in Texas, some in Florida, and then a huge swath of the country that just wasn't very well served. And middle market, call it $2 million to $50 million middle market bridge lending space. And bridge lending, in our minds, is short term, typically special situations financing, senior secured for commercial real estate. Short term being as short as 6 months, as long as 3, 4, maybe 5 years. Bridging through some sort of transition, whether it's just a timing issue, an actual physical asset transition, whether it's value add or construction completion or lease up, or some sort of sponsorship transition. So a sponsor who has a credit or liquidity issue, bankruptcy or litigation history, or they're buying out a partner. There's some other special situation or transitional nature to the sponsor or the partnership that they need to bridge through before they can get to a permanent execution. So, when we launched, our objective was, despite the fact that we're sitting in New York, our objective was to brand ourselves and operate as a true middle market, nationally branded bridge lender, filling in all the gaps that that existed in the secondary and tertiary markets throughout the U.S., really east of the Rockies and outside of the Northeast, which was the whole MO out of the gate. And over the past bunch of years, a lot of other short-term special situation lenders and certainly debt funds that are now CLO backed. A lot of people have realized that there's a ton of opportunity in the small and smaller balance and mid-market space in secondary and tertiary markets throughout the U.S. So we have a lot of company, but we are still a little bit of our own animal, and I can touch on that in a moment. But we sort of think of ourselves as a bit of a tweener in the bridge lending space. There's the high yield, harder money guys, and then there's the very low cost debt funds and CLO shops, and even some bank balance sheet bridge, and we're somewhere in the middle. And I think the best way to think about who we are relative to the pack is at sort of mid-tier pricing. You're paying a little bit of a premium over and above the low cost guys, but you're buying a ton of flexibility and ease of use, and prepaid flexibility, very quick CapEx draws. We typically turn draws in about a week versus 30 to 60 days for a bank or a debt fund or other heavily structured shop. We service in-house for the life of the loan. So from the time we fund until the time your client pays us off, we're talking with you, Charles, and your client directly. You're talking to myself or Michael or Andy or all three of us through the life of the loan. And from a prepay flexibility standpoint, we typically have a yield maintenance provision of as short as 6 months, right? So our money is really best used for shorter term business plans where ease of use, flexibility, and just efficiency through the process is paramount. So relative to the very high yield, harder money space, our mindset is we're lenders. We're going to come in here and be a partner to the sponsor, help them execute a business plan and get them back to a point where they can get conventional financing, rather than just we're solely asset-based lenders. We're going to give you 75% of value. You guys figure it out. Good luck. Right. That's how we think in our minds. We differentiate ourselves from the higher cost guys. Aside from pricing, we're lower priced than the double digit hard money arena. But we're really trying to provide a good service of let's make you a loan that's going to help you solve your problem and facilitate your business plan and get you back on track in short order.
Yeah, and I certainly appreciate that. I know that's been our experience with you, and I think it's very important for folks to realize a key word that you just mentioned. You mentioned the word service. So it's not just a lender, but you're literally providing a service. My understanding, and of course our experience, is you're working with that client to help them achieve that transition. And give me some examples of some of the things that you guys, in terms of the service aspect of what you do, along with the lending, that kind of helps individuals make that transition.
Sure. And remind me to come back to rates, because I realize we haven't touched on rates yet.
We'll definitely get to that. That's number one.
Yeah. First thing on everyone's minds. Yes. So I think it's helpful to understand too what types of projects we lend on. Mm-hmm. So let me start there, and then I can come back to sort of our process through a transitional asset. we lend again across the country, primary, secondary, and tertiary markets. We lend on all major commercial real estate asset classes except for hospitality, special use. So think golf courses, marinas, water parks. That's not our arena. We don't lend on skilled nursing, assisted living, or memory care. We will lend on independent living, which is effectively just multifamily, private pay, multifamily with maybe an age restriction and a food and beverage component. But any heavily licensed medical facilities we don't lend on. And ground up construction, we won't do either. So that leaves multifamily, office, retail, although those last two very selectively right now. Self-storage, medical office, some student housing again selectively, but we have become pretty clearly honed in on multifamily over the course of the past several years. So our book is probably 80% multifamily, value add, transitional multifamily. Again, class A, B, and C product, tier 1, 2, and 3 markets. And within that, 85+% of those deals have some degree of CapEx or construction completion to them. On the, back to sort of length of business term or length of business plan, the shorter term business plan is typically where we are best used. So someone's buying a garden style multifamily in Sherman and Denison, to use as an example that's relevant to you and me. A Dallas, northern Dallas, part of the world, buying a Class E garden style apartment community. They're paying $8 million for it. They're gonna put in a couple $1 million of capex. It's 80% occupied, so they can get in pretty quickly and start to turn vacant units and get the capex spent. They think it's going to take them 12 to 15 months to implement the entire capex budget, and they want a lender who's going to move really quickly with them through the renovations rather than slogging through what they think is a pretty quick execution, but having to wait on draws and having it be an arm wrestle on every draw, and it taking a couple months to get or even a month to get a draw processed. They want someone who's going to service the loan themselves. So when the problem arises, they can call me, they can call Michael, they can call Andy and talk through the issues. Something like that makes a ton of sense for our capital. Again, we'll turn a capex draw in a week on average. So we're just moving really quickly through the life cycle of that transition. So that makes a ton of sense. Conversely, if it's a deal where the sponsor thinks it's going to take them 3, 4, 5 years to implement a capex program, then they're probably highly focused on rate above all else. And they might not mind that it's going to take them a little bit more effort to get through a draw process and deal with a lender who's not servicing in-house and might be securitizing their loans and has things like cash management and rate caps as additional structure in their loans. We typically find that those 3 to 5 year business plans skew towards just the lowest cost of capital that the borrowers can find, whereas the sort of 12 to 24 month business plans, I think a lot of sponsors really appreciate the execution and ease of use and flexibility that groups like us afford.
Okay, yeah, it makes sense. Now let me ask you this: what enables you to get those draws out so quickly? Do you hire a local inspection company, or do you come down and do those inspections yourself, or how does
Yeah,
that
good
work?
question. So we work with a couple of engineering firms who we have a long history with, and we think alike. They understand what our sensitivities are and what we're looking for.
Mhm.
So on the front end, when we're diligencing a deal, and there's a capex or construction component to it, we and they collectively are going through the completion budget and opining on what the line item by item, what the cost to complete numbers are, what the budget numbers are likely to be, comparing that against the sponsor's numbers and the sponsor's bids, and then collectively sponsor Trevian and our engineering partner agreeing on the final number. This is what we think we need to collectively reserve to make sure that there are enough dollars in the deal to get you to the finish line. And then in terms of administering the actual draws, yes, sponsor comes to us with the draw package. Our engineer goes down. We don't, after initial visit, we're not going for every draw, but our engineering partner will go down, do a site inspection, and we're talking throughout the process, right? They're on site, they call us, give us an update what's going on. They get back, they process their paperwork, and in a couple of days we're funding a draw. So it's typically a week on average. It's just, a small unsecuritized, unlevered shop. We've got the flexibility to move really quickly through that process.
Okay, well, that's very good.
Yeah.
So,
And I'll add too, we can only move as fast as the sponsor
right.
enables us to, right? They need to put together a complete draw package. So obviously on every deal, the first draw is the what's the right word, is the sort of spottiest. Once we get through the first one and they understand what we're looking for, and we understand each other's process, then it's smooth from there on out.
Okay, well, very good. So, so you're finding a lot of these acquisition rehab type opportunities. Now, tell us about your the size of loan that you're comfortable making.
Yeah.
Yeah.
So we operate within a very wide range of whole dollar sizes. We'll go down to as small as a $1 million loan. Typically, if we're going that small, we're looking for pretty limited brain damage on deals. So we don't particularly chase a lot of really heavy lifts in the $1 million space. But a lot of our deal flow is, the driving nature of the bridge is time sensitivity, right? So at the small balance level, often what we'll see there is sponsors working on a Fannie or Freddie or HUD execution, and they just run out of time. And they need to get the loan closed in a couple of weeks. So they'll come to us and take a loan. We'll close the loan in a week or two, bridge them until the agency or the HUD execution is ready, and then let them roll off into the agency loan. So, in a situation like that, we would do a very small balance loan because it's very straightforward. It's not a huge lift, right, from a bandwidth issue. And then we'll go all the way up to 100 million. So in the past 2 months, we've closed a $3.2 million deal. We've closed a $54 million deal. We're in diligence on a $79 million deal, and everything in between. So it's really a wide range of whole dollar amounts. Average loan in the portfolio is about $15 million. So we definitely skew towards the heart of the middle market, $2 to $50 million. But we occasionally will have opportunities to do some larger deals as well. Okay.
So what does your leverage look like on these deals?
So we operate in a couple different manners. We invest on behalf of a few life insurance companies who we've had longstanding relationships with, and these are not names that you would know. And then we also operate out of our own fund, and there's sort of pricing differentials between those two buckets. In the insurance company world, those are unlevered balance sheet loans. And within our fund, we apply very low leverage. Are you asking about loan to value?
Loan to value.
Loan to value. Got it.
Yeah.
So loan to value, loan to cost, loan to value, obviously two different things. On a value add or transitional deal, or multifamily construction completion, which I haven't really touched on yet, but we're doing quite a bit of that as well. Coming in midstream and recapping out a construction loan on a mid-construction project that's gone over schedule or over budget, and then completing construction and bridging through lease up and stabilization. On that or a value add deal, we'll go as high as 80-85% loan to all-in cost, solving for making sure from a loan to stabilized value standpoint, we're inside of conventional debt capacity, right?
And that typically
market dependent, we typically want to be 70% loan to value or just inside of that.
Okay.
Unless it's a pre-review market and we know agencies are only going to 65 or 70, then we're going to toggle it according to that. But we're typically solving for, as a quick gut check, 70% of stabilized value.
Okay. Now that I would imagine 80 to 85% loan to cost in this market is hard to achieve since construction costs and labor costs have gone up so high. If you're that high on the cost side, you're not going to be at that stabilized leverage, that 70% leverage on the exit on the stabilized side.
It depends. I think probably on the whole, that's probably accurate. A lot of the stuff that we're seeing come to us, a lot of the deals that we're going after, lending on, we just closed one in Oklahoma City earlier this week. Sponsor bought it really well, got it under contract mid pandemic. The seller was nervous about the outlook of the world. This was pre-vaccine news. There were some collection issues. It was out-of-state ownership and self-management. There were collection issues. They were not aware of the fact that there was state incentives or state programs to reimburse landlords for back rent, and things just were not looking all that great at the property. And the sponsor's a local Oklahoma City investor, owns several thousand units in the market, knew that there was some runway here in terms of rent and upside, and it was getting a good number on it. And something like that, we ended up being 80+% LTC because stable value makes sense. It checks out, even though there was a pretty decent CapEx budget associated with that deal. The incremental increase in costs and labor costs, material costs wasn't so much to offset the value bump.
Okay, well, good. Well, let's dig in a little more with the bridge to stabilization, or really, well, let's talk about construction completion. Now,
Sure.
you don't do construction, but you provide a loan for construction completion. So, at what stage are you most comfortable coming into a non-stabilized mid-construction type project?